happy Tuesday, June 23rd. Welcome to another exciting edition of Rate Desk. I'm your host, Michael Thomas, here to talk about multifamily interest rates and other news. Going over to the markets today, all three major indices are up on the day, closing in the green, which is good to see. Tech continues to lead, especially companies that are more, quote unquote, the at-home companies related to, folks being at home more. Companies that can leverage that are certainly doing better in today's stock market. Going over to crude oil futures, good to see that sticking in the $40 barrel range, although it came down a little bit from where it was yesterday. Nice to see a 4 in front of that number today as well. U.S. 10-year Treasury yields up just a tick, 72 rounded up, 0.72, trading that range today. Going back over to the multifamily desk, still seeing very low rates, up a little bit on yesterday's indicative, but still very low on the 223F, looking at the 2.45 mid-range. That's 245 fixed for 35 years, and the 221 D4 new construction looking at 310 fixed for 40 years, non-recourse. Going over to the agency desk, again, seeing Fannie Mae still stick pretty low in the 290 range there for 10 years, as long as there's lower leverage involved and it's in more of a primary market. And on the Freddie Mac, you're seeing pricing kind of across the board. They are more aggressive on properties. You might see them in that lower 306 range. I would say mid-range for them is more around 315. And then of course it could be higher than that. Will mention, heard a quote today on a property that has affordability involved with it, which is a big initiative for the agencies and has been a big factor in getting better pricing. That is a 12-year, not 10-year, 12-year fixed rate, quoted at 312. So that is a pretty aggressive rate. Good to hear that there are still quite a bit of incentives on the agency side to find affordability in the properties that you're financing to reap those benefits. Going over to other news today, a couple things I want to speak with you about. One, I was reading an article in the Wall Street Journal that quoted a associate professor of economics at Georgetown University who was talking about how cash is being used by companies now. That cash gives them more options. You're seeing a lot more of the larger companies. They've either drawn down on lines of credit or they have just put a lot more cash aside and sold instruments to give them more options in this market. My question to you multifamily owners and developers are, what would more cash do for you? It makes me think of the ability to do a capital expenditures renovation on one of your properties, purchase a new property, so acquisitions, renovations. If there are increases to economic vacancy going forward, having that extra cash can help you meet those operating expenses with that lost income. So I see three major areas there that are certainly advantageous in this market for multifamily owners to follow Wall Street, really, and save more money on the side when they can. What that means in terms of financing typically means refinancing. I guess you could go out and raise more equity maybe if you're a large enough company, but then you're going to pay equity prices. So when you look at the price of equity versus the price of debt in today's market, there's a big delta there. So debt is much, much less costly. If you have the ability to leverage, that's a good way to approach having more cash on the balance sheet for your properties and for your multifamily company. Just a thought on that note today. And the other thing I want to mention is, where are rates going? Everybody wants to know that. I am no exception to that rule. I do not have a crystal ball, but one of the comments that comes up fairly often around this is the global market and how there are countries in the European Union, like Germany and France, that have negative 10-year yields. Okay, and seeing if our rates are going to be driven down to zero or driven down much lower if we in fact go negative on the 10-year. My response to that is, I think that's very unlikely. And the reason I think that's very unlikely is that even if our US 10-year Treasury yield tends to go lower, let's say even slightly negative like some of these other countries, in order for our debt markets to function, there need to be investors that are being compensated a return for making those investments. I mean, if you can get a corporate bond yield that's much higher, are you gonna do that, or are you gonna take this almost minuscule, non-existent yield and buy this multifamily asset, whether it's in a pool, whether you're buying a whole loan or not? I think it's very, very, very unlikely. That's point one. Point two, US market is not like any other market in Europe, okay? I know this, having been a lender for many years and interested in Europe. I studied in London. They don't have jobs for lenders that are the same in Europe as they do in this country. Why is that? It's because they don't have a secondary market like we do, okay? Go to Germany and ask for a 30-year fixed rate mortgage and see what they say. I think they're gonna know what you're talking about. And same with France and a lot of these European countries. They do offer financing in some cases. They might have fixed rates, but again, they don't have the large juggernauts that we do that are secondary market mortgage machines like Fannie Mae and Freddie Mac and Ginnie Mae doing trillions of dollars, literally trillions of dollars, passing dollars between investors and borrowers. No other country functions that way. Therefore, I think we do command a premium in our pricing on our debt for investors. I don't see that going to zero. Sorry. Just don't think it's not worth anything or worth very, very little. There's a lot of value to knowing that your source of repayment is going to be repaid. The U.S. economy still provides that. So I think rates are going to continue to be low. I was speaking with another lender today. He's heard 18 months. I think certainly till the end of this year, maybe early next year. It's still a great environment, but if you're holding your breath and waiting for rates to go down to a quarter point on stuff that you're going to borrow, lending rates, I think you're going to be waiting maybe forever. I don't see that happening anytime soon. Although I think we are in a historic, and I mean that, underline that, historic low interest rate environment today. That is my thought of the day. Thank you for tuning in to another exciting edition of Rate Desk. I'm your host, Michael Thomas, signing off.